Hey guys, Stockaholics, thanks for being here today. I think we're in the early stages of a commodities supercycle. The reason I have this Pepe Sylvia background behind me right now is because, quite like this gentleman from Always Sunny trying to explain a complicated idea that appears crazy to everyone around him, and I think he was in fact just genuinely crazy in this show. That's kind of how I feel when I'm talking about this topic, because I genuinely believe what I'm talking about is true, but I think that it does come across as a little strange. So I'm going to try and break it down, why I think we're in a commodity super cycle. And I'm really going to be focusing on it from the lens of demand. And more specifically, what I'm talking about is demand in the form of monetary growth. Now, even though I believe that we're in the early stages of a commodity super cycle, I'm also a firm believer in the idea of Occam's razor, and that is that the solution that is most often correct is often going to be the one that is the simplest. And so when we're thinking about an investment decision, often one of the best ideas you can have, despite the fact that I have a convoluted idea that we are in a commodity supercycle, the idea that we should try and base our investment decisions on is namely price. Can we get something cheaper, and do we think that sometime in the future it can be valued at a higher price? So this is a chart of the S&P GSCI. It's basically a commodities index against the S&P 500, and they're using it as a ratio. And if you've been anywhere in these commodity spaces on Twitter and places like that, you've probably seen a chart like this before. They use this chart to kind of show you that in terms of valuation in different stocks in the United States, the commodities, these stocks that are related to those, are deeply undervalued relative to other stocks. So we're thinking about it, a lot of these companies in terms of price, despite what I'm going to be talking about in this video, I think there is a lot of opportunity. Now, just because, I should also mention that just because things are cheap doesn't mean that they can't also get cheaper, even though we may be in a commodity super cycle. These things that last many years, and they're never straight up and down, straight up and to the right path. On my screen, I have a chart taken from the Crude Chronicles. I highly recommend following him on Twitter if you are not. I've been following him for years. He has an immense amount of historical data when it comes to oil and oil investing. Okay, so on this screen we have the DXY dollar index against oil price. I think there's a common idea out there, which is generally true, that as the dollar gets weaker, that increases the affordability for commodities. And the reason for that is because most trade that takes place in the commodity space is traded in dollars. Now, there's a lot of popular ideas out there lately that the dollar is dying, there maybe that trade will go back into gold, but really there's not a lot of evidence to support that. The dollar is the king of the dirty shirts, the cleanest dirty shirt in the hamper. And there's not a lot of reason to say that that's going to change, in my opinion, at least in the short term. Okay. Now, this chart is showing us that as the dollar weakened in the last commodity super cycle from about 2000 to 2008 or so was the peak, but there was a rebound, at least in the oil price after the great financial crisis. As that dollar weakened, the oil price went up. And that's because, again, the dollar, as it became weaker, allowed, especially emerging markets, China was the biggest driver of the commodity super cycle last time, it allowed them to buy more and more oil using cheaper and cheaper dollars because that dollar was going down. Now, I think one of the problems that I see in this idea is specifically this DXY index. If you guys don't know, the dollar index is measuring the dollar against 6 or so currencies in developed markets and not emerging markets. I think one of them is the British pound, the euro, the JPY. So the problem with this I have with the DXY index is that you're measuring the dollar against currencies that in terms of oil demand, their demand is not growing. So I really don't like using the dollar index because I think it can create false positives in correlations in this space. And so even though there's clearly some relationship here, the problem is that you're measuring the dollar against other currencies that aren't really fundamentally related to the oil price. I think what we should really be thinking about is monetary growth in the United States and increasing the pool of available dollars. Or another way to think of that is dollar strength in relationship to emerging markets, where we see the majority of oil demand growth. Remember, in the developed world and in all of the countries that the DXY is being measured against, oil demand is not growing anymore. In fact, in many places like Europe, it's been shrinking. And so as I just mentioned, the commodity demand growth that we see out there in the world comes from emerging markets. And this is a chart taken from the IMF to kind of quickly show you, and we can visualize this, right? The places where we see the biggest demand growth in terms of commodities are all of these places in Asia and specifically in Africa, more or less, right? So these dark green areas, you have the biggest GDP growth this year in 2024. And this is, in a lot of these places, these are the kind of GDP growths that we're gonna continue to expect over the next several years. Now, I'm a believer that the dollar is, and at least not in terms of the DXY, I don't know what these other developed markets are going to do with their currencies that they're measuring the dollar against. But I know that there's very likely to be increased dollar creation out there. And when that happens, all of these places that have GDP growths that are in the higher ranges here, the dark green color, they're going to have even an easier time purchasing commodities because of the trade deficits, the way that the global trade system is designed in the United States. And as those dollars escape the United States and head into these places that have higher increasing commodity demand, it's going to allow them to purchase these commodities a lot easier than they could normally because of the lower depreciation in the dollar. Now, I just said why I think that there's going to be dollar growth happening, and I think that'll be a support for commodities growth in terms of demand in emerging markets specifically. But I wanted to talk about why I think that this is going to be the case. I'm not a firm believer in the idea that the US government is going to start printing money, or the Federal Reserve is going to go out there, push a bunch of money into the economy. Although we did see something like that recently, and I think that that was part of the reason that we saw commodity prices overall have these kind of big spikes up and down. The forces that had driven that spike largely in the COVID recession or recovery phase, I think those forces are largely gone. But I think that the underlying forces in terms of the normal conditions in which monetary growth happens in the United States are still there. So if you don't know, typically the way that money or dollars are created in the United States is through the private banking system. When a bank issues a loan to somebody in the general public for whatever reason, that is created money that didn't exist previously. We have something called the fractional reserve banking system. So roughly for every dollar that's in the reserves in a bank, they can lend out 10 more into the economy. So when they do this, it creates dollars that didn't exist before. So the question you have to ask yourself, well, what is it that causes a bank to lend? And how is it possible for there to be monetary growth in this regard? I think that the main thing that limits banks, even though I just said that there's reserves, isn't necessarily the reserves, but who is the target of these loans. And I think that the reason that we have these periods of big monetary growth in the United States and then subsequent periods of smaller monetary growth in the United States is largely demographic based. So who are the people that are getting these loans? They generally tend to be demographics of young adults. So when you have a certain period of an expansionary demographic of young adults who come up into their loan-aged years, you get increasing amounts of lending. And as a result of that, you get increasing amounts of dollars being created. I think we're in the cusp of one of those stages now. We have the demographic known as the millennials, and it is an expansionary demographic in the United States, which means that there is a bigger pool of loan targets for banks out there. And because there's more available people out there who will be seeking loans from banks that relative to certain periods in the recent past, that think that there will be a period of more inflation over many years as these young adults get past their loan-aged years, and that will ultimately, as these dollars escape the United States through these trade deficits, that will ultimately be the grease in the engine for the commodities and increase those demand in emerging market. On my screen, I have a histogram in the United States. This is basically breaking down population cohorts by age in the United States. And again, when we're thinking about monetary growth, we're thinking about loan-aged adults or increasing amounts of loan-aged adults. So for example, these 0 to 4 and 5 to 9-year-olds in the demographics down here, they don't really matter, because at least in terms of, they matter, but at least in terms of monetary growth, they do not matter because they're not going to be out there getting a loan. The biggest cohort of the current people who are first-time home buyers out there in the United States out there right now is the millennials. And they're an expansionary cohort. And so this means that there is increasing amounts of first-time home buyers. And the reason I started to bring up home buying out there is because the biggest asset out there in terms of value and in terms of bank loans out there is real estate, and specifically residential real estate. So when we have an expanding demographic of these first-time home buyers out there, this gives the banks the opportunity to increasingly lend to this expansionary demographic and cohort, and it gives that the juice to the global economy because there are more dollars being created. And to kind of show you guys this more specifically, this is taken from Axios, and millennials compared to some of the prior generations have been really slow in terms of, myself included, in terms of, I guess, growing up relative to some of our prior generations. And so the first-time homebuyer age in the United States is 35 years old. So when we're thinking about loans taking place, your first-time buyers, these are completely new loans being generated, especially when they're new loans taken out against new homes, okay? And real quick, I think one of the reasons why this shot up so much, I think a few years ago I was looking at this, it was like 31 or 32 was the average first-time buyer. Because the Federal Reserve spiked interest rates so quickly in this current cycle that we're right, whatever it is that we're in right now, it pushed up, I think, this first-time home buying age a little bit, because you think about, well, who are the people who can afford to buy homes? It's generally more wealthier people, and as you age, you tend to get more wealthy over time. So when they caused this big spike in unaffordability, I think that also caused this big spike in first-time home buying age. But we can see this in other places, that your biggest first-time home buyer demographic out there now isn't BlackRock. It's actually your millennials, the first-time home buyers, and they're getting brand new loans, and when they do that, they're creating dollars. Now it takes some time for these dollars to escape through the US trade deficits out there, but they do, and as they do, they will, in my opinion, grease up that global economy. And so when we're thinking about that IMF chart of emerging market economies and those green countries on that map I was showing you before, I would expect, because there's more lubricant coming from this source, there's more dollars being created through this source over time. I think that it'll juice up the GDP growth over time and juice up commodities demand at the same time as well. And I think that's why, there's this axiom out there that says, okay, well, inflation is good because of commodities, right? And the question I've always been asked was, everybody seems to repeat this idea, and it's like, well, okay, yeah, but why? Why is that the case, right? Why does inflation regimes do good for commodities? It's because commodities are denominated in the currency, right? And who are the people trying to buy the commodities are emerging markets. And how do they do that? They do that with dollars, right? And I know, again, this is a lot of moving parts, but I genuinely do believe this, and I think there's a tremendous amount of data to support this idea. Now, last thing I wanted to show you guys is this is a chart of Chinese GDP growth. The last super cycle in terms of commodities demand growth, huge surges, took place from about 2001 or so to approximately 2008. And a lot of people attribute Chinese growth to the cause of that super cycle. And in many ways, I would agree that that was the cause. But I don't think it is the main cause. I think that the main cause was US expansionary monetary growth. Now, you can see that this GDP growth slowly went up over time in China. During this time, China increasingly became a trade partner with the United States. A lot of people credit the super cycle kicking off to when the Chinese joined the WTO. I don't see a lot of relationship there, because the growth in China during this period it equaled the growth rate in trade from the United States. And the same thing happening in the United States at the time. Oh, excuse me. This is a chart of housing during the time. And this is a chart taken from Federal Reserve. This is new privately owned housing units started. And from approximately 2000 to 2006, we all know that there was a housing bubble taking place in the United States. So during this time, there was a lot of easy money. There was a very tiny expansionary demographic in Gen X at the time, but I think, I don't know how much of an influence an increasing amount of Gen X had on home buying at the time, but we do know for sure that there was a housing bubble, and what was taking place at the time, there was a lot of lending taking place into the general economy as people were using debt to buy those homes at the time. The same time, a lot of that trade in China specifically was increasing. What happened? This dollar creation, through the biggest mechanism of dollar creation in the United States, the housing market, was facilitating a GDP boom in China, in my opinion. And one thing very interesting you can see right after that is that when this housing crash started over here in 2008, and until about very recently, 2019 or so, you can see, we go back here to Chinese GDP growth at the time, and they've had, relative to that prior period, very anemic growth. And so they've had a lot lower growth in terms of commodity demand in this recent period than they did in that 2000s to 2008 period, right? And I don't think that this decline over here is a coincidence. There's some economists out there. Jeff Snyder is one of them. He mentions that the period that we've been in is kind of been the silent depression. And if you look at kind of any GDP charts of a lot of places in the world, especially emerging markets, they look a lot something like this, right? And so, again, well, what is the reason for this is because your lubricant in terms of your dollar creation during this time was anemic, because there was not a lot of loan demand in that biggest asset out there. Now, leading to where we are today, we're not at extremely high levels of new housing starts taking place right now. The reason for this is because the Federal Reserve spiked interest rates to an extreme precedent in terms of rate of change, and it made housing extremely unaffordable. In a normal market, I would expect that this trend line that we've seen over here to kind of continue as the Federal Reserve lowers interest rates and the market kind of gets back into some kind of free balance. Now, some things have changed. This is kind of why I got really interested in learning about housing, and I recently made some videos about housing, is because things are not exactly the same like they were in 2000, 2008. I don't think that we're going to see a commodities boom in much the same fashion. I think that it's a lot more likely that in the United States, as these millennials mature and become first-time home buyers, and again at a lot slower rates in terms of age than the previous generations, this chart is going to be a lot more gradual. And that's because the banks now have a lot more stricter requirements in terms of lending. The the first time or anybody who's buying a home using debt has to really prove that they can make the mortgage payments, as opposed to many times in the past where that was no longer that wasn't the case. And there's also certain things that we have to take, I think, need to take some time to ramp up that changed after this crash over here. And the home builders, I think, have been a big beneficiary in the recent short term, but they also have to go through an expansion phase too. And I think they may need to build up some of their resources. There may need to be increasing competition in home builders to improve affordability. As you have more competition in that space, that will increase both housing units and increase affordability. And okay, I know this was a lot. I think I could go on for about an hour. There is a lot more historical data out there. I might make a video kind of looking at it in the past, in some previous generations, on this mechanism and dollar growth and commodities demand. I am very convinced that this is very convinced that this is the cause of big demand surges in commodities, primarily. But it is messy, and I could go through this chart and we could break it down bit by bit, and I might do that in a future video if there's some interest out there. Anyway, curious to hear you guys' thoughts. Thanks for watching, and I'll see you guys soon.